Good morning, everyone.
Morning, Gert.
How are you?
Angizwa lutho.
Good. As we start off, just before we begin, I see there's still a few people
Ivolume ngizoyenza kuphi-ke manje?
connecting.
Sangizwa.
I'm going to ask all of you to, if you move your cursor to the bottom
Ngisho
left
ilona yami ayina-volume.
of your screen, right on the bottom left, you will see there's a little microphone that says mute or unmute. So at the point in time,
Angeke ngizwe lutho.
going to allow for questions. And if you want to ask a question, then you have to move your cursor to the little microphone and just unmute yourself. I'm otherwise, just to make sure that we don't have interference, going to mute all of you now. Very well. Let's start. I see there's some more people trying to join. So at this point in time, as I informed all of you beforehand, we have what is normally called a contradictio in terminis. It's just the fancy Latin word for an apparent mutually destructive conflict. Now, let me explain this. What I mean when I'm talking about a contradictio in terminis or a conflict, on the one hand, we all say that the pandemic is catastrophic, and you'll see we're going to deal a little bit with what has been said and written in the press and in the media. But there seems to be common cause that the COVID-19 is catastrophic, and that the impact of it on the economy throughout the world, as a matter of fact, not just South Africa, is dramatic, and will have dire consequences for most everybody. Now, this is on the one hand what we say. On the other hand, what we're also saying today is, despite or notwithstanding the dire consequences and the awful nature of this pandemic and the economic meltdown potentially as a result of it, we are saying that there are extraordinary opportunities for the property investor. And I'm going to set out to explain to you why I'm saying that. And I just want to get some feedback. Dion, I see you, you're already admitted. Won't you just unmute yourself for a brief moment and confirm that you can actually see the coronavirus and extraordinary opportunity on your screen?
Yes, I have. Yes, I can see it.
Great. So then I'm just going to mute all of you again. Now, okay, I see there's still constantly people joining, but I suggest due to the time constraints that we carry on with it. Now, I always preach whenever there's a seminar or a workshop. Most of you know me by now. And I always propagate that a property investor is somebody who has to have some form of interest, not just in land and property, but also in particular in economics and finance. So what I've always said, what I do is I read the financial pages of the newspapers, and I online, I make sure that I keep up to date with News 24 and those channels. Now you can literally choose which one or ones tickle your fancy and subscribe to it. Just for interest sake, the power of these media channels is extraordinary. What we started to do a week or so ago is we actually registered a YouTube channel which we use to upload the various videos and news and further developments. And what is interesting, over the past approximately 5 days, this channel has been visited hundreds of times, and the videos have literally been, the one video I saw this morning has been viewed 253 times. Now, what I'm suggesting is, if you want to be a property investor, whether you invest in one property or hundreds, or like some of our developers do, thousands of them, then you need to know about the basic concepts of economics and tax applicable to property investment. So, having said that, on the 15th, I read an article on Fin24 written by Lamise Omaji. It is on your screen. And I'm just going to deal, I copied the whole thing, but I'm just going to deal with excerpts from it to first give you the bad news, and then give you the good news as a consequence of the bad news. This is why I refer to it as an apparent contradictio in terminis. Now, you'll see that it's actually not a contradiction. The first thing is that they all agree, all of them, and I've read hundreds of articles over since lockdown, is that they all agree that the national lockdown in South Africa, let's forget about the rest of the world, will lead to irrecoverable financial losses for SA businesses and compromised trading conditions for the remainder of 2020. And that is according to the Chamber of Commerce, South African Chamber and Commerce of South Africa. So there's no doubt about it. All the leading economists also agree about it. What is interesting, if you have a look at what the Reserve Bank says, and this is reality. Now, this report was actually released by SACI, South African Chamber of Commerce and Industry. It was released basically a day after the Reserve Bank cut the repo rate by an additional 1 percentage point, and the repo rate, as it is at the moment, is sitting at 4.25%. Now that translates to, from a banking perspective or a mortgage bond perspective, to a prime lending rate of 7.75%. And what is interesting, have a look at this. Immediately after that, the Reserve Bank also predicted that the the economy in South Africa will contract during the remainder of 2020 with 6.1%. Now, that in its own, and you'll see a little bit later why we actually think that the prediction of the Reserve Bank is very, very conservative. That 6.1%, I think, is extremely conservative, and we can expect much more. I'm gonna show you a little bit later. Saul, yeah, I see Saul says he has no sound on his side, so I'll try and manage that. Saul, perhaps you must just check your settings on your computer, because I see I'm not muted. Howard, I can see you. If you can hear me, just nod your head, please. Great. So you can, Saul, yeah, please do me a favor. Just check the settings on your computer on the towards the right bottom of your screen. You'll see there's a, of course, I know you know these things, but just check if your speakers are not muted, perhaps. Okay, then I see on my side the internet connection is somewhat unstable, so I hope it comes through properly on your side. Now, if we accept for the first, in the first instance, that we have seen an almost unprecedented drop of interest rates by the Reserve Bank, the repo rate, in a record time, because literally during the past 4 weeks, the Reserve Bank cut interest rates twice with 1 percentage point per shot, and that is extremely significant. And you'll see it is almost unheard of, in the sense that this didn't happen in South Africa since approximately 1984, and prior to that, more or less just towards the end of the Second World War. So this is extraordinary. I had a discussion with our partners, Green Door, who do our bond origination, and Gerrit had a look at the statistics, and since 1920 approximately, until date year of, the average prime lending rate during this period, so let's just call it 100 years. As a matter of fact, it is 100 years. The average prime rate was 10.25%. Now, if we're sitting at 7.75% at the moment, then of course it is significantly below the average during the past 100 years. And it has to give you an indication of the severity of the situation at the moment. Now, subsequent to what the Reserve Bank said, I made two notes. The first thing is, resulting from this and the economic meltdown in South Africa, we will most probably find that people, individuals who were aiming around about now to purchase their own homes, in other words, a primary residence, they would probably delay this decision. And the way that the economy is at the moment, and this is of importance to developers, we have a number of friends and partners who are developers, and the one thing that we know about the rest of 2020, you guys, is that the purchases or the prospective purchases of primary residences would taper off significantly. And you would probably find, and I actually want to contact some of our developers and ask their feedback. You would probably find that people who would normally purchase in a development property as a primary residence, that those numbers drop, and probably quite dramatic up until now, because of uncertainty. People don't like uncertainty, and they don't like potential threats. And specifically when it's about money and about being able to put food on the table and pay the car, pay the rent, all those necessities. So what it means is that we can accept as given that compared to previous years, the people who would actually buy primary residences would probably delay a decision to do that well into next year at least. Now, once we accept that proposition, then it has to tell us something about the perspective from the investor. And I just got a message from Howard. Yeah, Howard, I know you. Nice seeing you. Howard says he's of the opinion that the lower end of the market will not be affected as much as developments above 1.5 million. Now, I'm actually compelled to agree with Howard to a large extent, in the sense that, of course, any property transaction beyond 1.5 million at this point in time is going to be the exception rather than the rule. That's the first thing. Howard, you and I can have a discussion at a later point in time. I'd love to do that. The reason, I must just add, why a significant percentage of our normal sales to primary, as primary residents might be impacted, is because of the economic uncertainty and people losing employment, etc., etc. Howard further says he reckons that there will be an increased demand for people to get out of shacks, and I think government will push for this. Great, thanks for that, Howard. From our perspective, you'll see a little bit later that the prediction is that thousands of businesses will actually go belly up, and we're going to deal with it. Now, normally, a large percentage of that primary residence purchaser would be the employee whose company went belly up. So those people are, as far as we are concerned, out of the running to purchase properties. So in any event, there we have it. And yeah, Howard, I'd love to have a chat with you about it sometime or another. Now, the second consideration that I thought of was the potential for the increase in ALA transactions. Now, we're not going to dwell on ALAs today. I'll try and do a video on the YouTube channel, and you can go and watch it there about the ALAs in more details. But the bottom line, or a synopsis or summary of what an ALA is, it's actually an acronym for the Alienation of Land Act. It's Act number 68 of 1981. And what it does is simply this. It makes possible that a person can buy a property from another person, even though that property is still bonded, and he can buy that property on installments. The term of this agreement has to be in excess of a year. And of course, the interest rate that the seller charges or the installment that the seller would require from the buyer may not be less than the installment what the seller is actually paying to his bond. Now, what it means is simply this. It is analogous to going to BMW and you fall in love with a car on the floor and you say to the salesperson, well, look, I love this car, but I don't have 1.6 million or 800,000 or whatever. And they would say, show us your financials and we'll have a look at it. And you can buy this vehicle on credit. And they approve it. And what happens is the following. You leave with a car. But in reality, that car does not belong to you. It will only belong to you. And you will only get ownership once you have paid that final installment. Until such time, BMW or ABSA or whomever will actually own that vehicle. You have, during the period where you drive this car, you have the use and enjoyment of this vehicle. You also have liabilities and obligations. You have to take care of it, insure it, service it, and importantly, you have to pay the installment. So an ALA is analogous to the position with a credit agreement in respect of the purchase of the car. You buy a property which is probably bonded from somebody on installments over a period exceeding 1 year. And included in those installments, of course, would be interest that you're paying. It is almost as if the seller will be giving you a bond, but it's not in fact a bond. You will have the occupation, use and enjoyment of this property. Let's say the term is 18 or 19 or 20 years, and you will only get transfer of this property at the point in time where you have paid the full purchase price of this property. So people are going to be in trouble. It's unfortunately a reality. And this will provide scope and opportunity for the purchase of existing properties in terms of the Alienation of Land Act or the ALA. Now, what is interesting, the International Monetary Fund, this was Tuesday the 13th, I seem to remember. They called this pandemic, the world should ready for the worst economic downturn since the Great Depression of 1929. Now, we in South Africa, well, none of us here probably were alive in 1929, but history tells us that the impact of the Great Depression in South Africa was nowhere near as severe as it was in the United States and Europe. One of the basic reasons for it, of course, is that our economy was not remotely as advanced as the economies of the United States and Europe at that point in time. Now, what is interesting, the IMF, if you compare that with what the Reserve Bank had to say about it, they predict a contraction of the economy by 5.8% during 2020. So they're even more conservative than what the Reserve Bank is. And you'll see a little bit later that both of them are woefully too conservative in their expectation. Now, what is interesting about this is that Richard Downing, who is a senior economist at the South African Chamber of Commerce and Industry, wrote that cash flow problems are expected to continue throughout the remainder of the year, and they have come to the conclusion that large numbers of businesses going under and job losses are to be expected during lockdown and as a consequence of lockdown. Now, we have always maintained that this is just reality, and you'll see later that this is not unique. This is not new in history. There's nothing new under the sun. It's not the first, and it won't be the last calamity that people on this planet have to endure. But the one thing that we've always preached is that as a property investor, you have to limit your risk. Now, there's a number of ways to do it, and one of it, or a few of it, is if you're remotely in a position to make additional capital payments from the moment that your bond is registered, and we're going to deal with the numbers, then you have to do that. Now, it is upon the understanding that you applied and was granted an access or a flexi bond. Standard Bank refers to it as an access bond, and ABSA calls it a flexi bond, which simply means the following. You're allowed to pay additional capital into your bond. Now, let's say for argument's sake, the principle is the following, for those of you who don't understand it yet, is if at this point in time, your balance on your bond is supposed to be 500,000 Rand, and it'll gradually decrease over the next 18 years, then you're allowed to pay extra into this bond, let's say for argument's sake, 50,000 Rand, and that'll reduce your current balance, the money that you owe the bank, to 450,000. But you have paid in advance. So that 50,000 that you paid into your flexi or access bond, let's just call it an access bond from here on in, that 50,000 is actually available to you. You can go online onto your banking profile, you can transfer that 50,000 Rand, which you have paid in advance, out of the bond account into your current account or whichever other account you have. So that's the first thing, that we always insist that if at all possible, pay an additional capital amount every single month. Then the second thing that we always deal with during all our seminars and workshops is you have to provide for vacancies. Now, the percentage vacancy that you provide for will depend on how many investment properties you own. If you own one single investment property, the percentage that you have to set aside to provide for potential vacancies will be higher than the percentage which you would use if you own 20 properties. It is just a numbers game. So probably if you own one property and you're in a position where you can provide for this, you should probably try and provide for at least 1 month's vacancy per year if you own one property. Now, if your monthly rental is 5,000 per month, the income, then it translates to 60,000 per year. Now, 1 month would then be 5,000, which means the amount that you, or the percentage that you have to provide for vacancy is 1/12 of your annual rental income. Now, the more properties you own, of course, you would decrease that vacancy provision. And you'll see a little bit later when we deal with the financials, how important that is.
Gerrit, can you hear me if I can ask a question?
Yeah.
This vacancy provision, how do you provide for it? Is it the lump sum you pay into your account to stay in there for in case there's a vacancy, then you use it? Or do you pay extra? How does it work?
Is it Lefa?
It's Trevor.
Trevor, okay. Trevor, yeah. It's actually quite simple. What Bianca and I do is we actually combine the additional capital payments and the vacancy provisions. And what we do is we have specific percentages. I'm just going to mute you again just to avoid the background noise. What happens is this, is we have a certain percentage of all our installments that we actually allocate towards additional payments. Now, if you're prepared to pay an additional capital payment of R1,000 a month, for example, on your bond, and you've done your calculation and you found that you have to build up a vacancy provision during the first year of 5%, which is then basically, it boils down to R5,000 or in total. Then it means your total amount that you want to transfer into your bond account for the year is the 12,000 towards your additional capital payment of R1,000 per month, plus your 5,000, which would provide for or replace the loss of 1 month's rental. Now that gives you 17,000 for the year. And then, Trevor, the calculation is simply this. You take 17,000, you divide it by 12, and that is the amount that you will transfer each and every month from your check account or your savings account or wherever into your Access or Flexi bond. Now, if you have a look at that, then you would find that it is approximately 1,400 and something, let's just call it 1,500 per month in total if we stick with this example. So it means literally at the end of the month when you do your finances, you will take 1,500, you will transfer it into that bond account and leave it there. Now what has happened is if you follow this methodology, then you will see after 3 months, you have already accumulated an amount of 5,100 Rand in your Flexi bond, which would already at that point in time cover 1 month's rental income. Trevor, did this make sense? Just unmute yourself and
yeah, makes sense. Thank you. Makes sense.
Your question, did it make sense?
Yeah, it makes sense. 100%.
Okay, great. I'm just going to mute you again, if you don't mind. Now, so the third instance is this. In the past, we always had specific screening methodologies of prospective tenants. Now, remember, the source of your income from your property is your tenant. So if you choose unwisely, you may have unwanted consequences. What we need to do as far as the screening of tenants are concerned, we need to choose wisely. And from that perspective, what Howard didn't add in his message to me is that the lower end of the market and the so-called middle income is where the highest percentage of property transactions would be. It's always been like that because it's a numbers game. And the vast majority of economically active people, Howard, of course, are middle income people. So that's simply the reason why the highest number of sales of existing and new properties, newly constructed properties, would actually fall within that market segment of middle income housing. So it does make sense if you think about it, because how many people can actually afford a 10 million rand property in midstream compared to how many people can afford a 6 or a 7 or a 800,000 rand sectional title unit in a development in the West or the East Rand. So it's as simple as that. Of course, the numbers for middle income housing far outstrip the numbers of prospective purchases in high value properties, and then of course the so-called informal housing. Now, let me just add this: we as property investors, as a rule, do not deal with informal housing. And I just got a message from Howard. Thanks. I do agree that one needs to have very good screening, tenant placement methods in place. I've just changed my placement to not include commission earners due to COVID-19. Yeah, thanks for that, Howard. We have a similar consideration. What we're adding to this, and listen to this, Howard, is we're going to deal with the difference. And we've started propagating this during 2016, and I'm not sure whether you will remember at that point in time. It was actually at the annual general workshop, November 2016, where we warned that we have to adapt our screening methodology and that we have to differentiate or lean more heavily on what we call blue chip employers. Now, let me explain that to you, and this is going to be really important. We all talk about blue chip companies whose shares are traded on the stock exchanges. Now, what we're saying at this point in time, we have to make sure that we let our properties to people who are employed by blue chip employers, not blue chip companies. I'm going to explain this. Now, people, Howard, you already understand this, but bear with me. An example of a blue chip company would be these large mining houses, gold, platinum, diamonds, you name it. These companies, massive conglomerates, they are blue chip shares, blue chip companies. But in my view, they're not blue chip employers because they're exceptionally subject to the economic whims and the fluctuations in economic health. Now, what happens is if the bottom drops out of, well, we don't have oil companies in South Africa. Well, we have one or two, but it's not as if we have massive reserves of oil, crude. But if you take the example of what is happening in the United States at the moment with the prices of oil futures, those oil futures are actually sitting below zero. It's in the negative. The price of oil dropped, the bottom dropped out of it completely. So they stuck with large volumes of crude, which they can't offload. So the consequences of this is that the price that they can get for the crude per barrel at the moment is far below what the actual production cost of it is. Which means if it continues, they have to do a number of things. They have to, what they did, OPEC already agreed to cut production with 10 million barrels per day, which is a very large number. And eventually, if it continues beyond that, then of course they're going to lay off employees and they're going to close plants, etc., etc. Now, very similar to companies like large mining companies, is if the cost, the production cost of gold or whatever commodity is being mined there falls below the market prices of that particular commodity, then it means that particular mine is simply not making money, it's making a loss. And then what happens, immediate consequences, they have, they lay off staff and retrench, etc., etc. So this is to demonstrate where, why I say that a blue chip company is not per definition a blue chip employer. So if you compare that large mining conglomerate to, for example, national government, or a company which is occupied with the production of so-called essential commodities, then if you compare the safety of the job safety and security of a mining employee with the job safety and security of somebody who's employed by national government, then 10 out of 10 times the job security of that person employed by government is far better than the job security of the person who's employed by that mining house. Now, please don't misunderstand me that I'm preaching or that I have anything against mining houses. They have their place in the economy and they have a very, very big contribution to economic activity in this country. But we are looking at the profile of the tenant that we want in our property. So it's as simple as this. You take the path of least risk. So if I have to choose between a tenant who works for national government or a tenant who works for a mining house, then 10 out of 10 times I choose that tenant who actually works for national government. Now, similarly, I can immediately tell you that if you're unsure how to make that determination, what is a blue chip employer? I can immediately tell you that any company or any group who's in the business of production of essential services and essential equipment and commodities, you have a pretty good idea that the employment security of that particular employee is acceptable. A company which manufactures equipment and plant for the use in, for example, rail infrastructure, that's an essential commodity, that's an essential service, and national government and private owners of railways, like in the United States, they have no choice but to maintain their infrastructure, which means the company that manufactures these plants and machines and equipment, they will continue to survive no matter what the economic situation is. So I hope it made sense. So I can actually see you just nod your head if it made sense. Good. Now, if we, just for interest's sake, we've already seen that by the end of March, the sales of new vehicles declined by 18%. 18% is a significant number. It's a massive number. Let me tell you why. We went into lockdown on the 23rd of March. So literally during the period 23rd of March until the last day of March, the sales of new vehicles dropped with 18% year on year. So tell me that is not a dramatic decline. So we will see all of this. And I just want to add to this. The businesses who will battle to survive are those businesses who manufacture or produce and or sell luxury items. It is as simple as this. People will be conservative, they will be uncertain, and people will not buy during these times expensive sound equipment and new expensive vehicles, etc., etc. Now have a look at this. Initially, the lockdown was, as you know, meant to be implemented for 21 days. And at that point in time, when it was still 21 days, look at this. And how this is part of what my argument was at the beginning, is the Reserve Bank, before the 2-week extension, predicted about 370,000 job losses and the closure of 1,600 businesses. Now, I can immediately tell you now that subsequent to the extension of the lockdown with 2 weeks, and whatever we can expect or what we will get during May and June, because I believe it's going to be a gradual lifting of restriction. It's not going to be open house all of a sudden on the 4th of May. I promise you that. So these numbers, as far as I'm concerned, you can more than double it. Now remember, if you just consider for a moment, let's say for argument's sake, many people predict, many economists predict job losses in excess of 1 million people who they predict will lose their jobs, and the 1,600 businesses that will go under. You can probably, as far as I'm concerned, subsequent to the extension of the lockdown, double that. Now, what happens is this. The problem is not just ours. It is also a problem for the fiscus. Now, the fiscus is just the government's purse. In other words, the government's bank account. Now, how do they fill this purse? By collecting all sorts of taxes. That's how government earns its income or its money. Now, if you consider for a moment, if we lose 1 million jobs during the course of 2020, those 1 million people will immediately stop paying any form of tax. And if we lose 1,600 to 3,000, 4,000 businesses, they will not earn income to pay income tax. They will not collect VAT to pay VAT, etc., etc. Now, if we accept for the moment that according to the numbers that I have, approximately 21 million people in this country are allegedly economically active. Now, if we accept the number of 20 million, and if we say that 1 million of those 20 million people are going to lose their jobs, then it literally means it is 5% of the workforce or the economically active people who will lose their jobs. Now, it doesn't sound like a lot, but the truth is, 1 million people for the rest of the year will not be able to buy primary residences. They, as a matter of fact, will struggle. It will be an uphill battle for them to put food on the table. So there's no doubt about that. Now, if we take that perspective, then what I'm saying as a synopsis is, notwithstanding the fact that the pandemic and all the economic considerations is downright bad news and catastrophic, the consequence of it is that it's really good news for the property investor. And I'm not saying that pandemic is good news. I'm saying that the economic realities occasioned by the pandemic and the economic crisis is in fact good news for the property investor. And let's just take it one step further. What I also said is that the supply and demand effects of this extension will reduce growth and deepen it in the short term as businesses stay shut for longer and households with income spend less, according to the Reserve Bank governor. This will likely also increase job losses from previous estimates, with further consequences for aggregate demand. The impact will be particularly severe for small businesses and individuals with earnings in the informal sector. So if you have job security, then it means the following: all of this will provide you with exceptional opportunities as a property investor. Now, FNB send out, they continuously send out information, and just to bring perspective, because the one thing that I need to tell you is what goes down must come up again, and nothing except perhaps death is ever permanent. So we shouldn't be in a position where we depressed to the point of inactivity. The reason for it being the following, and this is why I included some feedback from FNB. They remarked that the impact of all of this on the JSE was quite dramatic, and it's true. And they say this market decline has hit the JSE All-Share Index hard, and the virus concerns have resulted in large decreases in share prices. All of this is true, but have a look at the graph that they provided. Now, unfortunately, I apologize. I tried to enlarge it, but the years at the bottom are so small that you can probably not read it. I can try and just for the moment zoom it. Doesn't seem as if it's going to be possible. Okay, but I can tell you this starts during the late 70s. Now, if you look at the curve, this is the JSE index. Now, the JSE index, if I oversimplify it, is if you take sort of the top 100 companies on the stock exchange and you add all hundreds share prices, you add it up, and you divide that by 100, that will give you an average share price or index. So I say again, it's an oversimplification, but that more or less gives you the idea. Now that index, if we start at where it was during the late 70s, early 80s, I just received another message from Tyron. Tyron, I hope I pronounced your name correctly. My apologies if I got it wrong. I'll deal with this a little bit later. Okay, somebody just told me I can increase the percentage. There we go. Aha. Well done. Thanks for that. So Tyron, yeah, I'm gonna answer that question. I don't want to do it out of sequence, but if you ask Howard, he will agree with me. The time to invest is now. There's no reason, Howard, am I right, why you have to wait for lockdown to get done. Howard, if you agree with me, just nod your head. Absolutely. Good. I'm in good company. So that's part of the answer to your question, but I will deal with that in a little bit more detail later on. But the truth is, it is now time to make hay, I believe is the expression. So, so there you see it. Now, yeah, you can almost see the numbers, but it starts in 1978. I just want to try and reduce those thumbnails. There we go. Ah, there is a nice one. Okay, so have a look at this. This is the index on the stock exchange since 1978. And I find this extraordinarily informative because look at where it came from. It was actually below 10,000, the index. And remember that calculation method? So that's where it started in 78. And then during 1988, was what was called Black Monday. It was throughout the Western world, it was an economic crisis and it was called Black Monday. And there you can see the drop in the index. In other words, the average decline in share price on the JSE. So you can see at that point in time, people were really scared and concerned because for them it was a dramatic drop. But if you have a look at what's to come, then you can see it was actually pretty insignificant. Yeah, Howard, we're not going to deal with 13 secs today. And I would really love if you and I can have a discussion sometime or another, because I'm slightly concerned about the sunset clause in 13 secs. But I'll fall for it, and later on I'll explain the section 13 secs advantages. Let me just say this, Howard, that most of the members actually already understand 13 secs, because we do sort of regularly seminars about 13 secs. But yeah, okay, I'll fall for it and I'll explain it a little bit later on. Thanks for that, Howard. Now, you can see then it gradually went up. Now, the one thing you have to understand, this incline or this growing graph, this upwards curve, is also the result of inflation. Just keep that in the back of your head. Then during approximately 98, during that period, 98 to 99, the Asian crisis hit. And you can see that actually for a number of years, all the way to 2001, 2002, it really caused havoc on the financial markets. And then we hit during 2003, immediately following shortly upon the Asian crisis, the tech bubble burst. Now that was actually significant, and a lot of people lost their shirts and everything else, as a matter of fact. And the large hedge funds and pension schemes, they made an immense loss during that period there. Can you see that on the graph? Then the recovery after that, and that's why I warned you, what goes down must come up again. What drops will come up again. Now have a look at that phenomenal growth. Now that was what we called a bubble. It just went up too much, too soon. And it had to correct itself at some point in time. Now this was 2008, you remember those days? Now this area here was the direct result of two pieces of legislation. The one is the Consumer Protection Act, and then the other one, which you know by now, is the National Credit Act. All of this led to the introduction of, in particular, the National Credit Act, to try and protect the consumer against abuse by credit providers. Because have a look at what happened here. Now you can see it didn't fall rock bottom immediately. It was a reasonably quick process, but the span, if you look at this, is 2008, and it bottomed out sort of during 2009. But you can see there was dramatic. But what I want you to understand is, look at the bottom line here. That is the bottom line. So if you compare it to where it started in 78, you can see it's far higher than what it was at that point in time. Now, then it, well, as I said, when it hit bottom, it started going up again. And this is where we are at now. Have a look at those heights, those incredible heights that it reached during 2018, 2019, and coronavirus struck. Now, what makes this unique, and I've never seen this before, is if you look at this, it is almost a straight line down. It bottomed out and it literally let me just see how it says. The benefits of this X not in place, we would have had the same issues. Yeah, I must just add, Howard is 100% correct. I'm not knocking the National Credit Act. What I'm saying as far as the National Credit Act is concerned is it's not negative because it was meant to protect the consumer from or against overindulgence and overexposure. However, I'm not so sure that it was as effective as they meant it to be and as everybody hoped it would be. My personal opinion is that that it allowed, unfortunately, for the abuse of unsecured credit. And that was one of the unforeseen and very negative consequences. But thanks for that. But Howard is 100% correct. The introduction of the National Credit Act saved many backsides in the sense that it would disallow you the opportunity to significantly purchase, for example, property way beyond your means, as the banks and financial institutions have to comply with the provisions and the restrictions in the National Credit Act, and in particular sections 81 all the way up to 83, which deals with reckless lending. And there are severe consequences that'll befall a lender who recklessly lends money to every Tom, Dick, and Harry. There are severe consequences. And it means that the banks adhere to a general rule or rules which are all aimed at protecting us as consumers and investors. And yes, Howard is correct. The total destruction of the subprime housing market or lenders market in the United States during 2008, we didn't see anything remotely as bad as that. And we were, of course, helped by the National Credit Act to avoid that. So our property, and especially the middle income and lower income property market, came out of it reasonably healthy, whereas in the United States, it led to the almost total destruction of that market segment. So yeah, thanks for that, Howard. To return to this, I'm saying this situation, this national lockdown and international lockdown, where approximately 60% of all human beings on the face of the planet are in lockdown. It led to an absolutely unique situation where the JSE dropped in a matter of days, and it literally dropped like you would drop a rock down a well, straight down. Now, if you're concerned about this, please, I'm not advocating that you must go and sell all your shares if you have. Don't, because keep in mind this upward curve. If you draw a straight line, what is called interpolation, then you will see sometime in future it will reach again that point or that point. So don't go and flog all your shares and fall over your feet to get rid of it, because this is when you will lose. Hang on to it, and there's the reality. So don't flog it. Now, I've given you a lot of bad news. But there's really good news in this. And you can go and read Sibongile Khumalo. She's a journalist, and I regularly read what she writes. And she calls it, it's a worse impact than was seen in the wake of 2008 global financial crisis. You have just seen that, didn't you? If you look at this drop here, it far outstrips and outweighs what we saw during 2008, so she's right. But she had a look at what BNP Paribas had to say, and I like reading what these people publish, because as a rule, they're pretty damn spot on. They added to everything that was said. They cautioned and they said, remember, it is not just the pandemic. It is not just lockdown. And it's not just additional costs to the country and the economy and healthcare and that sort of thing. We have to understand that there's a history behind this, that over a number of years prior to this point in time, the reality was that our economy was already struggling. This is what they say. So this is to add, the pandemic adds insult to the previous economic injury. And I cannot put it any better than that. So it is compounded effect. Now, as they said, and as you know by now, including the Reserve Bank's first rate cut at consecutive Monetary Policy Committee meetings in nearly a decade. So this is reasonably new territory for us. Now, what is important, and Howard, you guys, I'm not sure whether you've also had the same feedback. Have a look at this. Is they are 100% persuaded that the rate cut, the rate of 4.25% at the moment as we see it, the repo rate and the prime lending rate of 7.75 will be reduced again in sequence during the course of 2020. So BNP are not the only people who are predicting this. They are saying during the course of 2020, they expect, and they've already provided for it, another drop in interest rate of 1.25%. Now, if you look at that, and Howard, I just want to make sure that, there we go. Howard, did you get the same information? Yeah, Howard actually says, you're 100% right. One of the reasons why the Reserve Bank would actually do this is a desperate attempt to stimulate the economy and to get construction and those economic activities going, because that will create jobs. And in any event, as Howard correctly pointed out, our rates at the moment is in any event significantly higher than what it is in the rest of the economies, in the developed economies specifically. So what is the reality? Come Christmas 2020, as far as I'm concerned, our prime lending rate will be sitting at more or less, lo and behold, 6.5%. Pencil that in, because this is, Tyron, to also answer another part of your question, keep in mind that these interest rates will have a dramatic impact on your affordability. And we're going to briefly look at this, how massive this impact is. Now, the rest of it, I can always send this to you if you want it. Now, back to the predictions for the year. BNP, they actually predict a contraction of our economy during the course of 2020 of 8.5%. They're saying our economy is going to decline or grow smaller with 8.5%. Previously, they predicted a contraction of 4%. And again, I promise you, these guys are still conservative. Now, if you keep this in mind, and I'm telling you now, my opinion is we're going to see a contraction towards the end of January next year of approximately 10%. There's no doubt in my mind. Now, what I want to make sure that I'm not misunderstood. Let me just see what Howard says. The rand will get stronger as people will bring their funds here, even if we are junk. Maybe not the big players that have to conform to the Citibank index, but others will put the funds here as everywhere else. They're getting close to zero. Yeah, Howard, you're absolutely right. Because if you compare the interest rates that we have here, and remember, especially government bonds and those things are going to give really good returns out of necessity, because we have to borrow approximately 400 billion rand shortly at the moment. So you're absolutely right. We would probably see a stabilization of the value of the rand against the dollar. Now, thanks for that, Howard. Now, what is important here is the following, is that if you accept what BNP says, that they predict 8.5%, let's just call it 8%, contraction for the rest of the year. Do you realize that we're almost at the end of April, which means there are only 8 months left in this year? Now, if you translate this 8.5 for the rest of the year, then it literally means that they're predicting a contraction of 1% per month. Now, if that's not shockingly significant, then I don't know what it is. It is massive. Now, all of this is the bad news. Here starts the good news. All of them agree that we would see a rise or a growth in our economy as from next year, 2021, and they actually predict a 2.3% growth of our economy during 2021, and then they predict a further 2.2% in 2.7% in 2022. Now, if you add the two, if you say, okay, next year and 2022, if you add it together, then you see it boils down to a 5% growth in our GDP during the next 2 years beyond this year. Now, if you take my word for it, that we're going to see a decline in 10% in our GDP for this year, then it means at the end of 2022, we will not have made up lost territory yet. Because if we lose 10% this year and we get next year 2.3 and the year after that 2.7, that will give you 5%. So at the end of 2022, we will still come up short 5%. Okay, just make sure that we know that. I call this good news because the good news is that as from next year, we can expect growth of the economy. Now, I just also had a look at what Davy Ruet, the chief economist at Efficient Group, had to say. And he says at the moment the unemployment rate is 29%. The truth is, yeah, those may be the published numbers. But what is not included in this 29% are those people who a long time ago stopped looking for jobs. They're not included in these statistics because they don't form part of the statistics. And then, of course, the lazy people who are never interested in finding a job, they're also not included in this. But you have to put this in perspective. The last time I had a look at the unemployment rate of people between the ages of 18 and 35, it is in excess of 50% of these people who are unemployed. People with university degrees are currently unemployed. And this is a reality. So it's one of the things that we have to keep in mind. The IMF, in conclusion of all the bad news and the media coverage, is they call this pandemic an unprecedented threat to development in Africa. Yeah, that may be so, but as long as you are realistic in your expectations and as you don't lose sight of the bigger picture. So, if we have a look at this, then we're going to have a brief look at the continuity in my rental income. Very well. What is the situation as far as my rental income is concerned at the moment? And I have received numerous calls and emails about this, and I'm going to deal with it because it's actually not that complicated. One of the videos that we're doing at the moment, which will go onto the P3 YouTube channel, specifically deals with the issue of rental and whether your tenant is allowed to withhold rental or not. Now, there's some background that you can read at your leisure. And now what happens is, the reality is this. Your tenant is sequestered at home, and by the end of March, your tenant perhaps received maybe just a portion of his salary, or in many, or if not most instances, his full salary. The problem is this: what happens at the end of April? Because a large percentage of employees will receive, perhaps if they're fortunate, 50%. And many people, yeah, Howard, I would gladly do this. I'm sure, obviously, I have. What I'll do is I'll follow up this seminar, Howard, with a mail where I attach all the spreadsheets and this this newsletter to everybody. Yeah, thanks, Howard. I actually believe I have your email address. Anybody else who want additional documents, just mail me, please. I'll try and get it out to you as quickly as possible. So, what happens now? So, the problem wasn't end of March. The problem is going to be end of April, and I promise you, end of May. Now, okay, Tyron. Tyron, just let me know if I'm pronouncing your name correctly. Now, what happens end of April and end of May? Now I'm going to remind you of what we started preaching in 2015, 2016. And that is, I say again, additional capital payments into, somehow I succeeded now in making, okay. Do you have on your screen pink lines? Okay, Tyran, okay. Great, thanks. Now, for some reason on my screen, I now have pink lines, but okay, I'm not gonna let it bother me too much. Good. Let's just see if I can get rid of it. But okay, guys, just bear with it. It's not as if it's gonna kill us off. So now the reality is, and now I'm getting lots of feedback from members, as a matter of fact, all over the world, because the truth is we have members in 23 countries over the world. most people will, by the end of April, receive no salary. Some of the large companies will pay 30% of salary, and then some of the really healthy guys who pay 50% of the salary. The problem is it's not going to end the end of April, because as I promised you, you will hear this evening, hopefully 7 o'clock, but if we look at the history, probably 8:30, 9 o'clock this evening, the president will tell us about the gradual lifting of lockdown as from the 4th of May. It's not going to happen in one go, I promise you that. It's probably going to be a gradual process. Some of us will be lucky, some of us won't be. And those are just the realities. But I say again, if you had been cautious and industrious, you would have been paying over the past few years an additional capital payment on your access bond, and or you have been saving, you have been putting money under your hat, preferably also in your access bond, towards vacancy provision. If you have done that, then by now you will not be too stressed if your tenant can only pay you 50% at the end of the month and 50% at the end of May, or even nothing for May and nothing for April. Because now, of course, you have, as you all know, already that money saved up in your access bond. Now, let's say for argument's sake, you neglected to either pay additional money into your bond or save money as a vacancy provision. Now's the reality: for potentially 2 months, you're not going to get your rent. You also don't have a form of rental insurance, so what do? Guys, at this point in time, you do nothing. You do not phone your tenant, and you do not offer your tenant anything. What will happen is the following: is the tenant, as in many instances with Bianca and I, we've actually had a number of calls from some of our rental agents and actually a number of our tenants. The highest one being a property which is not a good investment property, where the rental is actually 35,000 Rand a month. And these people own their own business. And they simply said, they phoned and said, guys, please help us out. At the end of April, we will not be able to pay 1 single cent. And they asked if they could only pay 50% at the end of May. Now, I will be surprised if they actually able to pay that 50% at the end of May. So if your tenant or your rental agent makes contact with you and say, at the end of April, at the end of May, tenant will not be able to pay full rent or no rent at all, then you're going to do the following. You're going to provide this tenant with an acknowledgement of debt. This acknowledgement of debt and undertaking to pay is basically going to say the following, and we will help you guys with this. If it becomes necessary, just give us a shout, send us a mail. There we go. Those 2 email addresses, info@p3invest.co.za and info@gcsattorneys.co.za. That's my address at the one law firm. So contact us and you send your tenant this acknowledgement of debt. And let's say your rent, which the tenant has to pay, is 5 grand, and your tenant says, listen, I will not be able to pay any rent at the end of April. you do the following. You insert in that acknowledgement of debt the following. This is the tenant, Mr. and Mrs. or so-and-so, hereby acknowledge and confirm that I am duly indebted to Mr. So-and-so or company so-and-so, being the landlord or the owner of this property, in the sum of 5,000 Rand in respect of rental for the month April 2020. And I hereby undertake and promise to repay the sum of 5,000 Rand plus interest at the rate of, for example, prime lending rate, in equal installments over a period of 6 months or 9 months or 12 months or whatever you feel comfortable with, commencing the 1st of May, the 1st of June, whichever may be applicable. It's as simple as this. You mail this to your tenant or to your rental agent who will do this on your behalf, and the tenant will sign this, send it back, and there you go. Now you have what we call a liquid document, an acknowledgement of debt. And if in future you have to take legal action because this tenant did not make good his or her promises, then it's already a liquid document and you almost assured of a summary judgment if you have to proceed with legal steps. Does this sound cold-hearted? No, it's not. You have to understand, charity begins at home. If you can have your own personal space safe, then you can extend charity to the realms behind and beyond your own personal space. And this is your income. This is how you pay for your investment. And this is how you make ends meet by recovering the rental from your tenant. It does not mean that we don't have empathy for people who are in trouble. It's not what I'm saying. But charity begins at home, and make sure that you do whatever is required, because nobody else is going to extend you this courtesy. The bank's not going to say, shame you poor thing, just forget about it. The bank's going to say, pay me the damn installment. And it's as simple as this. This is business. So now what happens is you will have here and there a tenant who says, I cannot print and I cannot scan. So I cannot print this thing and sign it and scan it back to you. There's a nice solution for it. It's as simple as this. You say, okay, I sent you this, this acknowledgement attached to my email. You will forward that particular email back to me with the acknowledgement of debt, unsigned, attached. And in that email, you will say, I so-and-so, full names, identity number so-and-so, domiciled at so-and-so, preferably the address of the rental property, hereby confirm and admit that I agree to the terms and conditions as provided for in the attached acknowledgement of debt and undertaking to pay. Boom, it's as simple as that. Then you have it in formal communication. Now, you are left stranded because your tenant is going to pay off the installments from June or July onwards, but in the meantime, you have to pay your bond. Now, guys, this is straightforward. All of you should have received by now a so-called pre-approved offer for a moratorium or a payment holiday, and the banks are more than happy to accommodate you for a period up to 3 months. So what you do if this happens to you, you pick up a phone, you send an email, you contact your banker or home loans, and you say, please guys, this is a situation, please see attached the acknowledgement of debt that I've received from my tenant. In the meantime, I'm asking you to assist me and grant me a 3 months payment holiday, And I promise you, your bank is 99% of the time going to meet you halfway and allow you that. This is how you will then survive this. Let me warn you immediately. If your bond was in arrears prior to lockdown, the bank is not going to help you. Because if your bond is up to date, they will grant you a payment holiday. There's no doubt about it. But if you're already on their radar as the bond being in arrears, then your situation changes materially, and then you'll have to contact us and have a chat with us about options there. There are options, but we're not going to go into it at this point in time. And it is as simple as this. This, ladies and gentlemen, is how we deal with my income and the continuity of it during lockdown and following upon lockdown. Good. Let me just see if everybody, Howard, do me a favor. I'm sorry, I'm not picking on you. On your screen, can you see the green door? Great. Thanks, man. Now, I've been asked numerous times, Tyran, this is also aimed at you, is the following. Do the banks work during lockdown? Will they work during May? The answer is undoubtedly yes. We have already had, during lockdown, a considerable number of approvals in principle. If it's a property that's not already been pre-valued by the bank, like, for example, Howard, you get pre-valuations on the projects. If it's been pre-valued, the bank will actually, because it's been pre-valued, approve that bond and give you a final grant. If it's a property that's not been pre-valued by the bank, because remember, one of the considerations that the bank will look at is, do I find value in this property? In other words, it's as simple as this. The seller wants $1 million for it. Is it worth $1 million? That's the basic question. So part of this approval process is to get a valuator to actually have a look at the property and say, yes, Mr. Bank, this property is in fact worth $1 million. It's as simple as this. So if it's been pre-valued, the bank will grant you during these times a final grant. If it's not been pre-valued and still has to be valued, then the bank will give you an approval in principle, subject to evaluation of the property. Now, as most of you, if not all, know, we have partners with a bond origination side, Green Door Home Loans. It's a historical, great relationship. And what they have done during these times, and those of you who actually want this, you know what I'll do? I'll just send it to everybody in any event. Gerrit and Marita and the staff, they all work remotely like we do. And they will actually assist you. I see Tyran is asking me if new developments are good options at this point in time. Undoubtedly, Tyran, as far as I'm concerned, the in thing at the moment as we sit here are the new developments. And Howard made the point, part and parcel of that is a consideration of tax allowances, one of it being Section 13(6). And I think if there are some of you who want to attend a more detailed seminar about Section 13(6), I can do it next week. I have one day available, I think between 11 and 1. So we can do that. But for a number of reasons, let me summarize it. New developments at the moment is the easiest and the safest, for the simple reason that in most, if not all instances, the developer, before commencing his project, had at all the banks the property pre-valued. In other words, the developer wants 700,000 for it and sent the information to the valuation department at the banks, and they said, yes, okay, we're happy that it's worth 700. So that's the first thing. So it means you can actually get the final grant during lockdown or May or whatever may be the case. You don't have to wait for valuations. Tyran, the next thing that you have to keep in mind is, as we mentioned, there are tax allowances available only if you purchase a so-called new and unused property. It means it must still stink of paint. Nobody must have ever lived in it. It's new and it's never been used. So there's a significant tax allowance on certain conditions, which is available to the investor. And then, of course, the other thing is, during lockdown and during these times, you're not going to have a look at the property. You're not going to go there, because for the investor, you actually couldn't give a damn what it looks like. What you're interested in is not whether it's pretty or not. The question is it going to make money? Will I get consistent capital growth every year? Will I readily and easily get a tenant? And in the third instance, will I get a consistent growth in rental income over the years? Will it perform? And then, of course, is this a building that will last? And if it's a new development, of course, it's brand new. You don't have to worry or budget for maintenance. So to answer your question, Tyran, just let me know if I did answer it. The answer is simply yes, absolutely. If I have to choose, it's a new development, and it's as simple as that. Just let me know if I answered your question adequately. Great, well done. So I'll send this to all of you. It's as simple as this. When you receive this, you open the PDF document, and you can literally click on that little block there, and you can online communicate with Green Door. They will do a pre-valuation. You can actually, there's a pre-valuation online function, and just don't lie when you capture that information, because rubbish in will give you a rubbish answer. So please make use of this. As I said, I trust these people implicitly. We have a long-standing partnership with them. How it also brought to my attention is that people buy units when the development is launched, as there are price increases during the lifetime of the development. That's also true. So what Howard is saying is this, is if you're now buying in a new development, but the developer is only going to go into the ground January, for example. Yeah, make it February because it's builder's holiday well into January. So let's say it's still in the planning stages, all the approvals have more or less been done, etc., and they're actually going to start building it. Let's make it easy. August this year. Now, delivery of this unit in this new development will only be sometime next year. Let's say, for argument's sake, delivery will be end of April 2021. You buy at the price as it is during August. Now, during August, your price is 700,000, but we all now know that you can expect capital growth because of the effects of inflation. So if in that particular area, the average expected capital growth is 6%, then what you do, if it takes you a year before you get delivery of the unit that you buy now, July, August, then it means by the time that you receive your unit, you would have already accumulated capital growth on your 700 to the tune of 6%. Now, in my book, that is 42,000 rand on a 700,000 rand property. You clever people can check my arithmetic. So if you buy it July for 700, probably the fair market value by next year July, when it's delivered to you, it'll be now valued at 742,000. Did this make sense? I hope so. Good. Now, let me just see, there's another message. Great. Thanks, Tyran. So, what now happens is the following. I'm just going to unshare this document. If I can share this document with you. In Snowden, can you see that on the screen? I actually just want to make sure. Share screen, sorry. I actually chose the wrong one. Sorry about that. There we go. Okay, can you all see that now? Great. Now have a look at this. Keep in mind that at this point in time, and we're actually gonna run through the numbers. If we accept at this point in time that I'm not making an additional repayment, and we accept that I'm not even paying a deposit, I'm stingy, so I'm not going to pay a deposit, but there's also method in my madness. If I don't do that, I'll explain that to you. We know historically that my capital growth in this particular unit is 6% per annum, per year. The developer here guarantees, the developer provides a guarantee in this instance of income guarantee for the first year, and then another guarantee for 6% increase in rental from the second year, and then also guarantees the rental income during year 2. If we accept that inflation rate is 4.25, it's sort of okay. It took a little dip last week, but on average, we can accept that the 4.25 is what we have. And it's a 20-year bond, and the interest rate is 7.75 if it's prime. In this instance, this particular unit has an income of 7,586 Rand per month. My municipal rates is 227. My agent's commission here, if I actually have to use the developer because the developer is providing me with a 2-year rental guarantee, and that's 8%. And then if I do all of this, I buy this property for 883,000, no deposit at 7.75%, I start out with a shortfall of approximately $500 per month. Now, at this point in time, I just want to show you something. I want to see if I can move this. Okay. Just to give you an indication, 5 weeks ago, this interest rate was prime 9.75%. Now, before I enter this, have a look at this installment. This installment at the moment is 7251.44. This is what it is if it's 7.75 ago. 5 weeks ago, it would have been the following. Watch this. So 5 weeks ago, my installment on this particular unit was 8,378 0.25. Now, ladies and gentlemen, let me just immediately tell you, if I do the calculation, forget about the cents. But this is probably around about 1,027 if I do the calculation quickly. So from 5 weeks ago, it was this, until 5 weeks later today. Have a look. It was 8.3. It's now come down to 7,200. It's about a drop in installment of 1,027 bucks a month. That's how significant the impact of the interest rate cut is. And you remember when I said all that bad news and all that misery and all the doom and gloom, for you as property investor, for us, it has an extraordinary opportunity and upside. If you go, I'm going to send all of you, I'm going to show you a property analysis document, which if you're interested, I'll send it to you and then we can analyze your portfolio. If you do that, you will see how dramatic the difference in your cash flow will be. Because if I do this again and I say 5 weeks ago, at the moment, my shortfall is 500 bucks a month, no deposit. But 5 weeks ago, my shortfall was 1,626 Rand and 13 cents. You see the difference. This is actually extraordinary. And I want to show you something else. If you have a look here, 5 weeks ago, to be able to buy this property, I had to earn monthly 27,933, approximately 28 grand. This is how much my salary had to be 5 weeks ago to buy this property. My net disposable income 5 weeks ago had to be 8378. 8378. In other words, that's the money that I would have left after I've paid my obligations. That's what the bank wants to see. So if we go back and fast forward 5 weeks, have a look at how it changes. Now, 500 Rand discount or shortfall, and all of a sudden, I don't need 28 grand per month anymore to qualify for this. I now need a gross salary of 24 grand per month. All of a sudden. Plus, my net disposable income, if you have a look there, that is now required by the bank is 7,251 per month. You see how significant the impact of this is. Now, let's take it one step further. Now, let me just add this. If I particularly like ABSA, and I have no shame whatsoever to say this, because what ABSA does for us is ABSA, to a large extent, will take into account our rental income and our future rental income in some instances, on condition that I can prove that I will get this rental income. So this is just one of the issues that's important to me, but let's take this one step further. This is as it is now. Now, if what they're saying is true and the interest rates during the course of the year come down with another 1.25%, have a look at this. Remember these numbers? 7,251 at the moment. This is my installment. My shortfall per month is 500. And let me just see what the message is. Saki, that's great. you can certainly contact me. This, by the way, is also being recorded. Be safe. You have to tend to other things, but I will send to everybody the link for the recording of this this seminar. So don't worry, Saki, I'll let you have that. Great. Now, so as it is here, 500 shortfall, and let me just see, there's another. Great. Okay. So if it comes down with another 1.25%, and it's at this point in time, apparently not if, but when. So my shortfall, 500 per month, my gross income required, 24. So if I deduct that 1.25, have a look at this. Now, for some reason, I have to do that. There we go. Now, from a 500 shortfall per month, I now actually have, during the first year of ownership, a surplus. And the only time I have to add the levies for the first year are excused. On this one, we don't pay levy during the first year. But I will, during the second year, have a tiny shortfall, because what happens here is I will start paying levy during year 2. But the reality is also not just that all of a sudden it changes to a surplus immediately, with zero deposit, by the way, and all of a sudden the gross income that I now have to demonstrate to the bank is not 28 as 5 weeks ago, not 24 as it is at the moment, but in fact it'll come down to 21,900, let's just call it 22 grand. And you see what I mean when I say, let me just see how it says it will get to the point that people will buy as it's cheaper than rentals. You're bloody right, Howard. You're absolutely right. The question, of course, is that historically, we as investors, we actually want to own it and let it to tenants. But yeah, with the interest rates coming down like this, certainly you're probably right. It'll have an effect on people who buy as primary residence, simply because it now becomes affordable. Okay, good point. Thanks for that. So, by the way, Howard, I'm not sure if you actually did these numbers, but it's extraordinary if you look at it from this perspective. Now, I say again, despite the hardship and the fear and the anxiety and all of this, the opportunity for the property investor and the buyer at this point in time is really significant. And correctly, how it says, what the Reserve Bank is trying to do with dropping these rates is to stimulate the economy and to stimulate development and economic activity. And we must remember that a very large percentage, if not all our tenants, are those people who are not at this point in time in a position to purchase themselves, in the second instance, not interested in buying primary residence at this point in time. And we actually see quite a bit of that, especially with the young people who recently started working, etc., etc. So now what happens is the following, is we're going to play a little game with this thing. Is I'm going to open another spreadsheet, and we will use that as if I bought this property, not today, but let's say for argument's sake, I bought this property 5 years ago. And it's now already 5 years old. Okay, let me just stop this share and get the other document up. Okay, there's our restructure of the very same property. Now you will see this is as if we bought this property literally 5 years ago. There you can see I bought it 5 years ago, and what I'm now going to do is, if you remember the escalation in value, and actually I will have to go back to the document. My property value is now escalated to 1.182. And remember, I didn't pay a bond, a deposit. I bought it for 883. And if my interest rate is not 6.5 anymore, it's now gradually gone up, and it's now sitting at 7.75%. And I now refinance this property. Now, if I refinance it, the bank will only give me 80% of loan to value. So of this higher value, they will only give me 80%, which is 945,644 Rand. Now, what the reality is the following, is by simply getting my tenant to pay my rent and being meticulous about what I do, 5 years from now, if I buy it now, I can, and I must just make, you can see there's no capital gains tax. And because of the growth that I have, I can literally 5 years from now buy, and those legal fees, if it's at the same bank, will be approximately 4,000 Rand. So I will receive net from this refinancing 185,000. And ladies and gentlemen, the reality is that is probably a deposit on 2 new properties. And what is interesting is when I refinance it, I will have a tiny little shortfall for a short while of 63 Rand 98 cents per month. You see that? So refinancing it at that point in time will make it possible for me to, from the growth in equity in this property, get money which I can use towards the procurement or purchase of further investment properties. Now, I'm just going to, as far as this one is concerned, I'm just going to stop the share and go back to the previous one. I want to show you something. Okay, we're back at the previous one. What I wanted to show you is this. What I do with these calculations is, at the end of year 5, you remember we spoke of the 5. There we are. At that point in time, this calculator will actually tell me what my bond balance will be at the end of year 5, 756,000. But based on this capital growth, what my loan, my value will be. There it is. Sorry. 1182, that's my value at that point in time. I owe the bank 750. So my equity in that property at that point in time is 426. The value of it is 426,000 more than what I owe the bank. Now, this is if I don't have any additional payment and if I don't pay a deposit. Now, what is significant about this is I want to show you something else. Let's say I do what Uncle Gert says, and I pay an additional amount of R1,000 a month. Now, have a look at your installment, 6.5 at the moment. So if I go there and I pay from my own pocket into my $1,000 per month into my access bond, the following happens. All of a sudden, I now have R833 shortfall per month. But after 5 years, in the first instance, my bond term has now been reduced to 184 months, and 184 divided by 12 is 15 years. Okay. So I've reduced my term to 15 years and sort of 4 months. And what's more, at the end of year 5, my equity has gone up to almost 500,000. Now, what I want to demonstrate to you, if, for example, I can find it in my heart to pay a 5% deposit, hell, why not? Have a look at the result. Again, at the end of year 5. Now, all of a sudden, my term has been reduced to 182 months. And at the end of year 5, my value will still be 1.182 million. And I will owe the bank 647,000, which means I have equity in this property of 475,000. And by the end of 10 years, I only owe the bank 382. You see that? So it is all about numbers. And I always say, don't listen to my words. Watch the numbers, because the numbers speak for themselves. And now you will also understand why I always insist is that you have to follow the financial press and the financial media. And you have to be up to date on what is happening. If the Reserve Bank will have its monetary policy meeting Thursday, make sure that you either listen to it, alternatively, that immediately after that meeting, you have a look in the media to see what was said. Because it's important. Let me just see, I somehow missed a message there in the chat, but okay, I can't find it now. Very well. So this is the reality as far as the analysis of the property is concerned. Now, if you don't have any questions at this point in time about the analysis of this, then I think what we're going to do is we at this point in time going to unshare this document. So what happens is the following. Basically, I'm just going to type it here that you can see this. Section 13(6) of the Income Tax Act. There it is. And what it says is the following, is in the first instance, if you own in the same name 5 properties, and all 5 of these properties are used for business. In other words, you have tenants in them. You're not allowing your niece to live in it for free or whatever might be the case. They must all 5 be 5 properties used for business. And the second is they must be unused and new. It's just the other way around, but okay. New and unused. Now, you get an allowance in respect of those which are new and unused. So let's take an example now. You guys, if I lose you along the lines, send me a message on chat. Let's start with, I now bought 5 of these properties now. What happens is, I'm just going to make that 0. My purchase price is the following. Is, let's say all 5 of them are new and unused, and I will have tenants in them. I'm not going to allow my niece to stay in them. Then what happens is the following. There's my purchase price multiplied by 5. So what I pay for them, it doesn't matter that I get bonds, even if it's 100% bond. I pay for them 4,416,000. Now, what happens is it doesn't end there. So the calculation is the following. It says, okay, my total procurement value multiplied by 55%. Let me just get this in brackets. And that I multiply again by 5%. Now, this is sort of a meaningless number for you, but let me explain that. 13.6 tax allowance means the following. The receiver of revenue will allow you to recoup 55% of the purchase price of these properties over the next 20 years by allowing you the deduction according to this formula against your income per annum. So that's the formula. You buy 5 properties for this price. Your allowance is 55% of their total amount, and every year for the next 20 years, you can deduct 5% of that, which is 121,453 rand and 75 cents per year. So let's say, for argument's sake, you buy your properties in your company, and you have now earned an income for this year in this company of 150,000 rand. Now, what I must just quickly do here is I must just change the font. Not the font, the number, it's currency. We're not going to bother with decimals now. So what happens is I have an income, let's call it a taxable income for this year in my property holding company or in my personal name, but let's just deal with the company, 150,000. My tax allowance, which the receiver says I'm allowed to deduct from my income, is that 121. So I will be taxed on an income for this year of 28,000. And how this will be calculated in a company is that multiplied by 28%. So my tax, notwithstanding the fact that I have a net income of 150,000 rand, my tax for the whole year will then be 7,993 rand instead of 42,000, which it would have been if I didn't have properties which qualified for the Section 13.6 allowance. Did this make sense? Okay, this is more or less a short summary. I will do a 13.6 seminar next week. I'll send all of you the notice for it. Let me just see if I can. Is there anybody else who struggled with this concept? Okay, if you're uncertain about it, let me know. We'll do this online seminar next week. But you can see how significant it is that even though you're making money, you're not really paying tax as you normally would have, and this is because it's a new and unused property. Now, let me just tell you, let's say you have 5 properties, but only one of them is actually new and unused. Let me just see. There's a message from chat. Okay. Tyran, not to worry, I'll send, do me a favor, Tyran, just send me a mail to either of my 2 email addresses, and then I'll send you these spreadsheets. Now, let's say for argument's sake, what happens is I have 5 properties. 4 of them are not new and unused, but one of them I now buy. Then the number changes as follows. Then it's only there's my annual allowance if I buy this one, new and unused, and the other 4 are not new and unused. So what happens now, look at the difference, is that one single purchase that I make now, and Tyran, you asked me, why now? This is one of the reasons. Is have a look at this. Is instead of paying 42,000, that one single property that I buy, which is new and unused, will reduce my tax liability for this year with a good 7,000 Rand for the year. Nice and handy, isn't it? Now that on its own is well on its way to actually provide you with a portion of your deposit on a new property. I hope it made sense to everybody. Very well. So thank you, everybody. I really appreciate all your time and your effort in attending this. Howard, you and I will have a chat. Then we can discuss some of this a little bit further. And everybody else, if you, please do me a favor. If you need any of these documents, just send me a mail, and I'm going to type it in here and send it to everyone. Send it to gert@p3invest.co.za. There it is. There's the email address. If you want any of these documents, please just send me a mail. I'll gladly send it off to you. And on that note, thank you very much for your attendance. I really appreciate that. And I wish all of you health and prosperity. And as investors, I'm pretty sure that this is in fact your opportunity to become stinking rich and to provide for the future. Thanks, everybody. Have a good day.